Inflation numbers in June just came out and we might be in trouble. CPI prices increased by 5.4% in June, marking the highest monthly increase since August of 2008, just as the housing bubble burst and the stock market collapsed. We expected inflation to be bad, but not this bad. The median forecast from May to June was only supposed to be 0.5%, and we nearly doubled that at 0.9%. Welcome back to Stock Tricks with Nick, where today I'll be talking about the June CPI numbers, what transitory inflation is, whether these numbers should worry you, and how to protect yourself. If you're interested in all things finance, whether that be stock trading or increasing your credit score, you've come to the right place. Make sure you subscribe and hit the notification bell so you don't miss out on any of my videos. All right, let's get into it. On Tuesday this week, the June CPI numbers came out with higher than expected inflation. The two main numbers that you need to know is 5.4% inflation year over year and 0.9% inflation month over month. They also measure a core CPI, which excludes food and energy prices, and this came in at 4.5%. The highest increase since 1991. But let's back up here. What even is inflation? According to Investopedia, inflation is the decline in purchasing power in a given currency over time. For simplicity, say you go to the grocery store to get your food for the week, and that bill comes out to be $100. Then, 1 year later, you go to the same grocery store and get the exact same items, because you're like me and can only make 3 meals. But this time, your bill comes out to be $105. So that $5 extra, or 5%, is your inflation rate. Inflation has been escalating for a number of different reasons, including supply chain bottlenecks, a surge in demand as the pandemic eases, and a comparison year over year when the economy was at its worst. But probably the largest factor leading into these higher inflation numbers is the drastic increase in the money supply in the US. Since February of 2020, the M2 supply has increased by 26%. M2 is a measure of money supply, including cash, checking deposits, and near money. This means that nearly 21% of all the money that has ever existed was printed within the last 16 months. This is the largest single year increase in the M2 supply since 1943. And 4 years after that, 1947, the US saw the largest increase in the inflation rate at 19.7%. It's common sense. If you print more money, things are gonna get more expensive. And if you print 21% of all the money that's ever existed, that's gonna flow into the price. But it's not all bad. One thing that's supposed to offset inflation is increased wages. If cost of goods go up by 5% and your salary goes up by 5%, it's not much of a difference. Unfortunately, that's not what we're seeing. Wages are struggling to keep up with this blistering inflation rate. A separate report from the Labor Department's Bureau of Labor Statistics found that the monthly increases in consumer prices actually contributed to a negative real wages for workers. The 0.9% month-over-month increase far outpaced the measly 0.3% that wages went up. This caused more than a 0.5% hit to real wages in just 1 month. Even worse, the effects of inflation are harder on lower income earners. You see, high income jobs are more likely to compensate for inflation year over year, while low income jobs, not as much. Also, inflation typically hits basic needs more than luxury items. This is called inflation inequality. And on top of all that, a larger portion of low income earners' money go into these necessary purchases, which now cost more, while higher earners might just have to cut back on some of their extra spending. But before you hit the panic button, the government has assured us that a large portion of the inflation that we've been feeling is only transitory. If you've been paying any attention to this inflation news, I'm sure you've heard this term. Transitory is a comfortable buzzword that the government's been using to suggest that the sharp increase in prices that we've been feeling is only going to be short-lived. On Wednesday, just 1 day after the CPI numbers came out, Jerome Powell, the Federal Reserve Chair, spoke to the House of Representatives Financial Service Committee, and he did not change his tune. He is confident that the recent price hikes are associated with the post-pandemic reopening and that they will fade. And he stated that the high inflation numbers are for a small group of goods and services that are directly tied to reopening. From his statements, it doesn't seem like he's stopping the money printer anytime soon. The Fed is more than likely going to continue their bond buying and keep interest rates near zero until 2023. To be fair, we are comparing the prices now, while the country is reopening and demand is surging, to 1 year ago when everything was shut down and the economy was weaker. And we already mentioned the supply chain shortages. Most notably is the shortage in the production of computer chips that are used in new cars. And because we aren't producing as many new vehicles, this is spiking the prices of used vehicles. This was the case in June. Used car and truck sales were up 10.5% last month, which contributed to 1/3 of the CPI increase. And over the last 12 months, used car and truck sales are up 45.2%. Food and energy prices were also up substantially, 0.8% and 1.5% respectively. And I'm sure you noticed that gas was more expensive. The gasoline index was up 2.5% last month and up 45% on the year. As both countries and production bottlenecks open up, along with pent-up demand subsiding, we hope to see a decline in these inflation rates and for them to be proven transitory. But how long can inflation run at these levels before it's not considered transitory? Well, no one in the government seems to have that answer. But Nick, if inflation impacts goods at different rates, how did we even come up with the 5.4% number that everyone's freaking out about? When people talk about inflation rate, chances are they're referring to the CPI, or Consumer Price Index. CPI is a basket of hundreds of goods that we've been measuring since 1919. Those items can be broken down into 8 different groups. First, we have apparel, like clothing and jewelry. Next, we have education and communication, so think school tuition, telephone, internet bills, and computer software. Third is food and beverage, which includes both grocery bills and restaurants. The fourth group is housing, such as rent, mortgage payments, utility costs, and furniture. Fifth group, medical care, so hospital visits, prescriptions, dental and vision products. Sixth is recreation, meaning sport events, toys, and pets. Seventh is transportation, which includes vehicle purchases or leases, gas, car insurance, airplane and train fares. And finally, we have the 8th category, other, which includes hairdressing, tobacco, alcohol, and basically everything else. Because inflation is hard to quantify, there are other measures that are commonly used. My personal favorite is the Big Mac Index, which was created in 1986. No, I'm not joking. It exists, and people take it pretty serious. It's based on the theory of purchase power parity. This is the idea that in the long run, the exchange rate between 2 currencies will move towards a rate that would equalize the price of 2 identical baskets of goods between 2 countries. On this channel, I mostly talk about stock trading. So let's take a look at how the inflation numbers impacted the market. When the report came out on Tuesday morning, we didn't see an immediate impact. The markets opened relatively flat as traders were digesting the meaning behind the numbers. Then around noon, the market started selling off and we closed near the low of the day. While the popular indexes such as the S&P 500 and NASDAQ held up relatively well, the divergence was clear. The money was flowing out of risky stocks and into large cap tech stocks. Similar to how inflation impacts lower income earners, riskier, smaller stocks often feel the effects more. No matter how hard the apes held on, meme stocks were hit the hardest. GameStop down 11.5%, and AMC down 22% in just 2 trading days. During that time, Amazon was just 2% off its highs, while Apple made new all-time highs. So if GameStop and AMC can't save me from inflation, and my wages aren't increasing fast enough to keep pace, what can I do? The worst thing you can do is keep all your money in the bank, where you'll earn about 0.01% interest. By doing this, you're basically losing your purchasing power. You want to be owning either cash flowing or appreciating assets. This can include many things, such as blue chip stocks, real estate, gold, crypto, and luxury items, such as wine, watches, and PSA 10 Charizards. Anything that will either cash flow or appreciate in value is going to offset the effects of inflation. This is another reason why lower income earners are hit so hard, because they're less likely to own assets. Another way to hedge against inflation is to pick up 2 free stocks from Webull, which could be valued all the way up to $2,300. All you have to do is use the link in the description below, open an account, and deposit $5 with them. And then you get those 2 free stocks, again, valued all the way up to $2,300. And with that said, thank you for checking out my video. If you learned anything from this video, do me a huge favor and smash the like button and go inflate my subscriber count. And I want to hear from you guys in the comments. Do you think the inflation that we're seeing is just transitory, or do you think it's going to stay around a while? And what stocks or assets are you buying to help hedge against the risk? Have a great weekend, and I'll see you Sunday morning for a new stock breakout watch list. See you next time.